Hello everyone, welcome to the latest TM Brunston market update. I hope that you're all keeping safe and well during these rather unsettled times. I'm pleased to have with me once again Mark Shields, investment manager from Brooks Macdonald, who will be discussing some of the more pressing issues. Mark, welcome. Interest rates and inflation is a key one to talk about to begin with. What are your thoughts on recent central bank announcements?
Yeah, clearly one of the things we're very much watching at the moment, and the market has been very much focused on, has been the message from central banks as to the direction of interest rates and the impact that that is having on investment assets. So we've seen a little bit of the market beginning to expect what's known as a pivot from the Fed, so for the Federal Reserve, which is the American central bank. And what that means is basically the market is at times starting to price in a higher chance that the Federal Reserve will not continue to raise rates at the same pace as it has been doing for various reasons. And when the market sort of begins to believe that, then we are seeing reasonably decent performance from risk assets such as equities and at this point in time bonds as well. However, sort of fairly consistently, what we've seen is that the market has been willing to kind of get maybe a little bit ahead of itself and begin to think that the Fed is going to pivot and other central banks are going to pivot, only for those expectations to come tumbling down in one way or another. Now, we actually saw the Federal Reserve last night, as I'm talking to you now, announce their latest interest rate rise, and yet again they've done a relatively large interest rate rise of 75 basis points. However, a few of the comments that were made subsequent to the meeting did sound more dovish than they had in the past. And actually, the market initially reacted very positively off the back of that. However, then some subsequent comments that were made basically sort of implied that the Federal Reserve believed that they needed to carry on combating inflation, and markets fell subsequent to that. So we've seen a great deal of volatility being driven by comments and output from central banks, particularly the Federal Reserve. And again, today, this morning, as I'm talking to you now, we've seen the Bank of England do yet another bumper interest rate rise. So, this is something that we very much need to be focused on. I think we need to be wary of any market rallies that come about prior to these big announcements. I think we would rather be more comfortable maybe investing some of the less risky assets we have in our portfolios once we've had a bit more of a confirmation of a dovish stance from some of these central banks, which we haven't had a consistent message of that as of this time.
Tipping over into the world of technology, there's been some pressure on large cap technology stocks recently. Can you give us your background as to why this is happening, Mark, please?
Yeah, absolutely. We're in the sort of middle of so roughly in the middle of what is known as earnings season in the US, and this is basically a sort of relatively short period of time, 3 or 4 weeks, where a lot of large companies in the US report their earnings for the previous quarter, and basically we have seen quite a few large cap technology names underwhelm in terms of the earnings reports that they have been reported. Now, these have been a little bit underwhelming on the most part, and in some cases, I think it's fairly understandable as to why the share prices have been hit relatively hard in the kind of aftermath of these earnings reports. Meta, for example, was very underwhelming, but it also has had a bit of an impact on other large cap tech names that maybe didn't quite meet analysts' expectations, but weren't too bad, frankly. But they have been beaten up off the back of, frankly, negative sentiment. So, we have seen some of those more consistent cash generative large cap technology names once again coming under a bit of pressure, largely due to sentiment driven investing rather than any sort of changes in terms of their fundamentals. And so again, we sort of do remain reasonably confident in the prospect for large cap tech names over the medium to longer term. We may well continue to see volatility in these companies in the near term, but as I said, over the longer horizon, we really do feel that these companies should remain places in our portfolios for that long-term cash generative nature of them that we believe can outperform the wider market.
Okay, good. So that segues nicely into my last question, which is looking ahead. Clients are asking, are better times up ahead? And really, what are the key factors that you're monitoring to determine that sentiment may change into a more positive format?
Yeah, clearly at the moment, we have seen risk assets and traditionally defensive assets come under a lot of pressure. This has not really happened before, particularly not to the same degree as we've seen now. So a lot of kind of question really is, well, if these assets have come under this much pressure, then is now a good time to be putting some money to work, as it were, in the market? And I think that's not an unreasonable question to ask. And I suspect that over the medium to longer term, given that we've seen declines of 20% plus in the broad US market, 30% plus in the US technology space, and indeed we've seen assets such as gilts fall by 20% or so year to date. This doesn't happen very often, and typically you'll find that these sort of events are not a bad time to be putting money into the market. However, there is clearly risk that in the near term things could get a little bit worse, and that is certainly possible. But equally, we could well see markets rally quite significantly. And I think the three main things that we are watching very closely at the moment is that message from those central banks I've already touched on. If we do begin to see central banks become a bit more dovish, then that'll be very well received by the market. The second factor is inflation. If we begin to see inflation moderate, especially in the US, then that again will be very well received by markets. I don't necessarily think we need to see inflation falling back down dramatically, but we do need to start seeing inflation coming off the highs that it has been on. And lastly, we need to see those corporate earnings I've also mentioned hold up. And so far, aside from some of those technology names that I've already mentioned, some of the more sort of traditional companies have actually reported some pretty reasonable earnings. And so far for this earnings season, the US in general, the earnings season has been reasonably strong. Certainly, maybe a bit stronger than was broadly expected. But those are the three things that I really think we need to focus on. And when we begin to see more consistency and more comfort with regards to the messages that are coming across from those three factors, then I believe that will probably provide a decent base for investors to become a bit more confident in some of those risk assets, likely driving them higher from that point in time.
Okay, Mark. Okay, thank you for that summary, and thank you for watching. Also, thank you for your positive comments that we get back from time to time on these market updates. Please keep them coming in. So once again, as always, if you have any questions or queries at any stage, please be in touch with us. Thank you.